We are the team Chester. So our group mates is Charmaine, Rochelle, Angel, me, and Gerald. So just a land acknowledgement, Extended School of Management acknowledge that it is situated on the traditional, ancestral, and unceded territories of Coast Salish people, including Musqueam, Squamish, and Salilwata Nation. So this is our agenda for today, which we will be discussing as we go further on our presentation. And yeah, for introduction overview, the first one will be discussing about the 8 competitive decision rounds, 5 market segment between traditional, low and high performance size. For the second one would be the performance measured using the balanced scorecard that will consist of the financial profit, stack, price leverage, and cost control. Internal business process like plan utilization, production, efficiency, inventory, SG&A. And for the last one would be the third, which is the customer, which consists of awareness, accessibility, customer buying criteria, learning and growth, and which is under employee training, productivity, and long-term capabilities. So
Hmm.
let me just go back to the previous slide. So over the 8 rounds of the CAPSIM simulation, we manage our company across multiple market segments, making decisions in finance, production, marketing, and human resources. Our main goal was to balance profitability, operational efficiency, and long-term growth while responding to competitive market pressure. And below is the balance scorecard recap, which round will show you the result on the next slide. So the next one will be discussed by my colleague.
All right. So, hello everyone. Hello, Prof. So, I'm gonna be discussing the 4 rounds, which is the one, two, three, four. So, in round one, our team was really focused on staying stable rather than making big profits. The profits were small, but costs and debt were kept under control, which helped set a safe starting point. Operationally, things were steady. The plant was being used properly and SG&A were costs managed well, but there weren't many efficient improvements yet. The goal was just to keep things running smoothly. On the customer side, awareness and accessibility were pretty low, but that was expected. At this stage, the team cared more about getting the internal operations right than pushing hard on marketing. As for learning growth, there wasn't much investment yet. Early on, it was more about surviving and keeping things under control. So in round two, things started to look better financially. Our team benefited from cost control and some early sales momentum. Internally, production planning improved and operations became more consistent, which helped support early growth. So customer awareness also went up, which helped our team to start gaining traction in the market and become more competitive. There were some small gains in productivity, but investment in long term learning and development was still pretty limited. So by round three, financial performance started to dip a bit, competition increased, and profit margins got tighter. The operations were still stable, but because there wasn't much investment in automation or improvements, efficiency gains began to slow down. At the same time, customers' expectations were rising faster than just their product improvements, which made the company less attractive in some key segments. Learning and growth investment was still low, and this started to hurt the long term competitiveness. Let's move into round four. In round four, profitability weakened even more. Margins continued to drop and competitors were getting stronger. Operationally, things were still under control, but production and capacity decisions didn't line up as well as with what the market actually needed. Customer awareness stayed strong, but our team fell behind competitors in accessibility and buying criteria. So overall, limited investment in people and innovation continued to hold the company back. So for the next round, I will turn over to Rochelle.
Yeah, I will be discussing the round 5 to 8. For the round 5 balance scorecard summary, for the financial, round 5 marked a turning point as we recorded weak or zero profits with low stock price performance. On the internal business process, operational efficiency was maintained but without strong margins. Cost control alone was insufficient. And customer awareness was high but weak product differentiation reduced conversion into sales. For the learning growth, TQM investment began to show small productivity gains, though too late to reverse declining performance. And for the round 6, for the results remained poor in round 6 with zero profit and weak shareholder value. And for the internal business process, plant utilizations and cost controls were strong, indicating operational discipline. And for the customer scores improved due to high awareness and better accessibility, but product fit remained weak. On the learning growth, incremental TQM improvement supported gradual productivity gains, but overall, learning remained limited. For the round 7, financial performance declined further to 5.1 out of 25, driven by zero profit and low stock price. And internal performance dropped to 9.1, mainly due to poor plant utilization despite good SG&A control. And customer performance stayed moderate at 15.6, supported perfect awareness but limited product appeal. Learning growth and improved slightly through TQM, but employee development remained weak. For the round 8 financial performance reached a low at zero point 0.7 out of 25, reflecting continued zero profit and weak market value. Internal process improved significantly to 19.3 with full plant utilization and strong working capital management. And customer performance remains stable with perfect awareness and improved accessibility, though buying criteria remained unmet. Learning and growth rose slightly due to ongoing TQM investment, but long-term competitiveness remained constrained. And for the performance review will be discussed by Angel.
Angel.
For the performance review, as you can see, there's a stock price from round 0 to 8 and the profit per round. Our team Chester experienced a strong start in the simulation, particularly in rounds 1 and 2, where our conservative strategy focused on financial stability and cost control paid off. This approach allowed us to achieve solid profitability and operational efficiency, culminating in a peak performance at the 63rd percentile in round 2. At this stage, our low-risk financial structure and efficient production gave us an early competitive advantage. However, beginning in round 3 and 6, our performance gradually declined as competitors, as you will see in the profit per round, as competitors invested more aggressively in product repositioning, automation, R&D, and marketing. Our continued emphasis on efficiency and cost control was no longer sufficient. Weak product differentiation and low contribution margins limited profitability, even though awareness and operational efficiency remained relatively strong. Next slide, please. And then the leverage in round 7 and 8, we were able to stabilize our operations by restoring plant utilization, improving working capital management, and maintaining high customer awareness. TQM investment also began to show small gains in productivity. Despite this improvement, financial recovery remained limited due to persistent product positioning gaps and low margins, preventing a poor rebound in overall performance. Our key success, one is the operational efficiency. That's our main strength throughout the simulation. And in most rounds, we achieve high plant utilization and effectively controlled inventory and SG&A expenses, allowing us to operate efficiently even under competitive pressure. And we also perform the customer awareness, reaching and maintaining a perfect 5 of 5 outscore from the middle to later rounds. This ensured strong visibility in the market and helped sustain demand despite weaker product positioning. And our another success was our financial discipline. By using a conservative leverage strategy, we minimized financial risks and protected cash flow, especially during low profit periods. And finally, our process improvement efforts, particularly through TQM investments, gradually improve productivity and internal process, providing a foundation for long-term operational stability. And our key failures, despite strong operations, profitability remained a major weakness, especially around 5 to 8, where profits were zero or very low. This was largely due to weak product differentiation, which kept contribution margins low even when production efficiency was high. Another key failure was late innovation. Delayed in investment in R&D, automation, and employee development made it difficult to keep up with competitors who upgraded their products earlier. And then we also face customer accessibility gaps as improvements in sales and distribution were slow and consistently lagged behind competitors, limiting market share growth. Finally, limited early investment in learning and growth reduced long-term competitiveness, slowing productivity gains and restricting our ability to respond quickly to market change. And then for the lesson and learned and future recommendation, let me call Shamin.
Uh, so I'm going to discuss the lessons learned throughout the simulation. So one of the most important lessons from the simulation was the early financial stability and operational efficiency that can create short-term success, as seen in our strong performance during rounds 1 and 2. Careful cost control, efficient production, and conservative leverage help us establish a solid foundation early in the simulation. However, the simulation also showed efficiency alone is not enough to sustain long-term competitiveness. As the market evolved, teams that invested earlier in product differentiation, R&D, automation, and workforce development gained a significant advantage. Our delayed innovation, limited contribution margins, and reduced profitability in later rounds. Another key insight was the importance of balancing marketing components. High awareness was valuable, but without strong accessibility and product fit, it did not fully translate into sales and market share. And finally, We learned that learning and growth investments must be made early. Delaying training, TQM, and productivity improvements restricted our ability to adapt quickly to rising customer expectations and intensified competition. Next slide, please. So, for our future recommendations, um, first we invest earlier in R&D to improve product positioning. By doing this, early investment in research and development would allow Chester to create products that better match customer expectations for specifications, reliability, and performance. This would increase contribution margins and customer appeal, helping the firm compete more efficiently in high-end and performance segments. Second is to increase automation sooner to lower unit costs. By doing this, investing in the automation earlier, Chester could have reduced labor costs, minimized production bottlenecks, and improved plant utilization. Lower unit costs would allow for competitive pricing while maintaining profitability even in highly competitive markets. Next one is balanced conservative financing with strategic leverage. So while conservative financing reduces risk, Chester overly cautious approach limited funds available for R&D, marketing, and workforce development. Strategy borrowing could have funded key investments to support growth and competitive without endangering financial stability. Next one is the expanding sales force earlier to boost accessibility. Customer accessibility was a recurring weakness for the Chester. Investing in sales and contribution earlier could have ensured products and reach more customers and convert awareness into actual sales. This would help Chester gain market share in segments where awareness was already strong. And lastly, to commit to continuous learning and growth from early rounds. So minimal early investment in employee development and TQM limited long-term productivity and innovation. With continuous focus on workforce trainings, skill development, and process improvement would improve efficiency, reduce costs, and create sustainable competitive advantages. Um, so conclusion will be discussed by Gerald.
Was it me?
Mark.
It's
Yeah,
Mark.
so in conclusion, it's been a long run with the courses. So the CupSim simulation demonstrated that the importance of aligning strategy, operation, and financial decision over time, while Team Chester maintained strong operational control and customer awareness, delayed investment in innovation and learning, limited profitability and competitive strength. The experience highlighted that early strategic investment, balanced risk taking, and continuous improvement are essentials for long-term success in the competitive market. So we've learned a lot regarding on our um, course with the professor, with you, Prof. We thank you for the experience that we've gathered and the knowledge. And that would be Team Chester. Peace out.
Thanks, Prof.
Thank you, Prof.